Hello everybody, welcome to the Trader Merlin Show. It is your Wednesday edition, Testimony Wednesday. We may actually talk a little bit about the GAAP issues going on with Congress today, but I'm going to try to get to our guests and spend as much time with our guests as possible. Of course, you guys know we've had Sam Evans on the program a bit from Stockability. Today we're bringing on his partner as well, which is going to be Dan Bustamante, joining us to talk about technicals versus fundamental analysis. I know it's a challenging subject, but we'll do our best to breach it here on today's show. So gentlemen, how you doing?
Doing good, very good. Good to be here. I decided I want to bring some company along with me this time, Merlin. You know, before you and I run out of things to talk about.
It's a maiden voyage of the trio on screen. I'm actually a big fan of that. I'm going to adjust things here to make it look even better for the show. Glad to have you back with us. I have never met you before, Dan. So tell me a little bit about yourself and your I guess trading and investing background, so our viewers know who are on the program today.
Yeah, so I've watched the show before. I know from Sam a little bit. So. Background, let's see. I started in finance when I was 20, so I worked at Charles Schwab on their active trading desk, so I was still an undergrad. Was going to go to investment banking, to that whole world, and then you had the market crash 08-09, so that was pretty much like, there was no way to get a job on Wall Street at that point, and I was like, that was a trajectory I was trying to get into. So luckily, I went to work for a futures prop firm in Scottsdale, Arizona, so I actually started to trade with some former Ford traders. I was a Russell trader, DAX, S&P trader. So I did that for a couple of years, and I got headhunted, went to Los Angeles, worked for a pretty big family office there. Can't say who, but I was basically handling like special situations, a lot of short selling. We did like deep dive research on shorting companies. So primarily during those years, I was pretty heavily short. Do you remember, what was there was a headphone, like skull candy.
Yep, skull candy.
So there was a lot of IPOs during those years. We shorted pretty heavily. Then I was pretty deep into the for-profit education shorts, and I spent basically a year and a half shorting that entire sector, that whole thesis. So that was kind of the background. I kind of cut my teeth there. This was a pretty like aggressive group of, I guess, desk of traders. So I learned quite a bit from those guys. Did that for a while, basically for 2 years nonstop, like just worked. That's all I did is work. And then I moved back to Arizona at this really small stint at this FX firm under European desk at night for like 6 months. And then I got recruited again as a portfolio manager, and I was 29 at a long short hedge fund here in Scottsdale. Did that for a few years, and then kind of randomly got into education. It was I kind of was doing it on the side. I had a few people ask me to teach them, and it started to expand. I'm like, this is kind of interesting. I like this. If anybody's been in the hedge fund world, it's
cutthroat.
It's unbelievably cutthroat, right? So, other thing too is people don't know this. The firm, so I wasn't like the partners, so we get paid out on a yearly basis. I've got to wait all year to get this like bonus, you know. I just got tired of doing that, so I just kind of made the transition into this. Me and Sam, when did we meet? Sam 3 years ago.
Pushing 3 years, 3 years now.
Yeah, so me and Sam met 3 years ago. I was kind of still with my I created a really small school, nothing like where you guys came from. But we did pretty well. We opened an office in Vancouver, Canada. We had a lot of students in Canada, actually. And I kind of did that for a while, partnered up with Sam and our current partner, Vince Sika, right now. We've been working hard to get to this point. So that's kind of a background. Yeah.
Got it. And in a short period of time, it looks like you've gone through just about everything from equities to options to indexes, futures, currencies, all that type of stuff. So a full gamut background there. Just so we can set the kind of the stage for today's show. In your background, your kind of education, were you focused on kind of the fundamental side of things? I mean, are you more of a technical guy?
So interestingly, when I started, I was going to go to investment banking. So the way you're actually looking at real fundamentals of companies to analyze and figure out, DCF models. So when I started, I was all fundamentals. I was 24, 25. When I went to the futures prop firm, it's pure price. So I came into this world to like technical analysis. I'm like, this is like voodoo. This is like bogus, right? And a lot of people think that. And as I progressed, I'm like, this is really good. So I'd say it's a combination. There's a lot of fundamentals in Los Angeles. We had to research like deep dive on balance sheets and what these for-profits were doing. So there was a lot of fundamental there. But as far as executing the actual idea, I did use a lot of technical, like a lot.
Right.
So that
kind of using the technicals for the big picture, and then maybe the refining it down in the smaller time frame. Now, Sam, you weren't managing money for anybody, right? You've always been trading your own accounts. Is that correct?
Yeah, I did some stints with it for a while. I worked with a fund actually in Norway actually for a while, and they actually, believe it or not, recruited me, Merlin. They actually sent one of their traders in one of the OTA programs.
Oh, nice.
Back in the day when there was just about 50 students in the room, and Paul, I won't say his last name because again, you have to be respectful of people's, privacy and stuff. But Paul was one of my students in there and helping get trading ideas. And he just called me one day, he emailed me, so we chat, and he's like, "Hey, do you think you could, do you want to come and work with the firm?" And I'm like, he goes, be the direct guy. And I kind of actually trained him. And then Paul went on to actually be the head trader for a firm called North Securities out of Oslo. And ended up, doing a lot of the things that I taught him. So I kind of went in and oversaw them, trained them how to be better and stuff. And I loved it, and that was a fund that was growing. And we were in talks with this big Swiss pension fund of injecting a load of money in Merlin. And I'll never forget, dude, it was so funny. The guy Raymond, who was the head of the fund, he was like this VC, this venture capitalist who formed this hedge fund, right? He gets on the phone one day, he goes, you made some really good calls. He goes, I want to know, how did you come up with these ideas? And he goes, submit your trade plan to me. And I'm like, well, if I give you my plan, what are you going to try and do? Kick me out because you don't want to pay me, right? I was a punk back then, as you know, Merlin. So, right. And he was like, well, no, I just want to get an idea. So I turned around to him and I said, well, it's funny you say that, Raymond. I could give you the idea, the plan. I said, but it's all based on fundamental analysis. It's real heavy, deep economics. I said, you need like a PhD in economics and finance to understand it. He went, oh, all right, then well, I'll leave you to it. Guys, I never did any fundamental whatsoever. It was Forex we were mainly doing, based on massive time frames and that. But that kind of got him off of my scent. And I did that for a while, but I got really disillusioned with it because, it was constant phone calls all the time. Mm-hmm. My wife will tell you we were engaged at the time. She's like, you got another call. And, one of the reasons why I walked away from it was like, as we started to do really well in the first quarter, Raymond, the guy, was turning around and saying like, step it up. And I was like, dude, I want to step it down. Let's just take it easy. Mm-hmm. Let's look at the big picture. And he started going a little bit rogue with some of the company funds and like doing his own trading. And he took this massive drawdown that was nothing to do with me. And I said, I'm not going to be involved with that. And I walked away from it. And it became too much like a job. So, and that was while I was actually with OTA that was going on. And it was good. And, I had the green light then, back in the day. And they knew about it and it was all good. But I did it for a while. But I cut myself differently. I started out, as a student of the market and then went into it and then decided, I don't want to do that again. And I've had people, I'll tell you this real quick. I've had one guy called me like about a year ago say, hey, I got some connections, this big VC firm out in Asia. They want to throw $800 million to you to manage. And I'm like, really? I'm like, that $800 million. And it's like, do you realize that's a full-time job? That is a full-time thing. You can't just like sit there on your laptop saying, I'll risk 1% of 800 million on it. I said, that's a job, that's regulation, that's full on like forming a company to do that. And I said, I'm not interested in that world anymore. And I'm happier being where I'm at right now, not having anybody to answer to. Well, except our students right now.
Yeah.
Our students
And you're not wrong. You're not wrong about that world at all.
Yeah, and I have no interest in it. Just so for the viewers, I have never traded anybody else's money but my own. And I have zero aspirations to. And it's funny, Sam. I know because you and I taught many times in OTA, and I'm sure this happened to you as well, Dan, where you're standing in front of a class or a group of students, and you're delivering a great presentation. Everything's going great, and then someone comes up and is like, "Hey, would you mind managing my money?" Don't even ask me, folks. It's not going to happen.
And it's not worth it either, the aggravation. It's like, one, we took and one of the things I respect about my time at OTA, there's a very hard line policy. I'm not crossing that line. Yep. And, we're also the same with our company. It's like, we're not here to manage your money. Yeah. Nobody cares about your money more than you, so you should be managing it, right? That's the whole tagline of Stockability. But, the other thing is, it's just too much aggravation. I won't even manage my family's money, Merlin.
Neither will I.
I just don't get involved in it. And like my sister, bless her, I love her to bits, but she's got a financial advisor and she thinks everything's wonderful. And sometimes she asks for advice, and then when I give her advice, she doesn't like it. And then I know if I manage her money, she's going to want to check it on it every 5 minutes, and I don't need that aggravation. So I'm like, you know what? People don't get that. People don't get that, and it's more powerful to have that skill for yourself. So Merlin, you didn't miss out. I would never go back to it. I'm not interested in it. And Dan and I probably talked about this. We want to create the greatest education company in the world, and this will be our legacy in the world. And then we'll probably go off and do other things as this thing grows as well. But working in funds is one thing I never want to do again.
Yeah. And I can't say as I blame you. There's, for those that, when you look at Sam's example there where you got, let's say, $800 million coming in, you make, 1%. It sounds like you're making a phenomenal living, but the stress associated with it. Right now, most fund managers are loving it because markets are just going up. The Fed is helping them become rich and rich and rich. When these markets crash, the landslide of garbage you have to deal with as a broker or a hedge fund is just not worth it to me, so I'll move on. Let's shift focus and go towards the topic du jour, which is technicals versus fundamentals, and I'm glad we've got a trio here because I think we all have different perspectives and takes on what it means to be a trader or investor, and I think we'll start at kind of the basics for all of us, which is when we start out in the financial world, you are taught fundamentals. When I went through college, all the emphasis, 99% of the emphasis was on fundamentals, which is what we're led to believe. We want to check a company's balance sheets, their earnings, all that stuff, management products, because obviously we're buying a piece of that company. And it all shifted for me in 1998 when I became more of an active intraday day trader. And the reason for that was I saw technical analysis and I was living for the next 10 minutes to hour or two. And obviously, who cares about earnings in that perspective when I'm looking at something for 10 minutes? So I'd like to get you both of your takes on technicals versus fundamentals. Where do you stand? Is one of them garbage? Is one of them absolutely critical? What's your take?
Dan, please go first.
So look, I'm not a big fan of company fundamentals anymore because of the way that the central banks have intervened, and it just skewed everything. So, but I am a fan of market fundamentals, and we talked about it this week in our first class. Foundational ability. So I use this model called 70-30. So it's 30% technicals, 30% fundamentals. So we come up with a worldview, an idea of a worldview, or an economic policy that might affect something. Then we lay on the technicals above that. So 70% is technical based. So I think in some sense you need to understand like money flow, understand what the yen's doing to understand U.S. equity markets. You need to understand that the European close matters for the rest of the trading session. I think people need to understand, I was teaching a lesson this week. People didn't know fundamentals on just options that you could trade SPY and QQQ puts 15 minutes before the open and after. So in the traditional sense of fundamentals, of company fundamentals, I just don't think it matters anymore. But I think market fundamentals do matter. And I think that's a big difference in being successful. So.
Yeah, and I like that you do a 70-30. I think for me, I can't say I discount fundamentals altogether. Obviously, I think you'd be naive or foolish if you discounted it altogether. I think it comes down to what is your trading plan and objective. And I went back to my day trading days back in the late 90s where, if I'm day trading and I'm out at the end of the day, I could care less what a balance sheet looks like or who the CEO is. It's just what is happening right now. So in that environment, as a day trader, it's probably 99% technicals, 1% fundamentals, and the 1% is me listening to Maria Bartiromo or Joe Kernan on CNBC. That's pretty much it. As we start to progress, I know that you guys, obviously your Stockability is not about necessarily making day traders out there. So is that kind of the overall approach in your education, is saying 70% technical, 30% fundamental?
Yeah, we try to keep it more, and I use this example. So if you were to work with me as a portfolio manager, so I manage anywhere from equities to developing a tail risk book to our index futures book. So the way I describe it is if I were to make you to a portfolio manager, so you're overseeing the markets, that's kind of the perspective. So they can say, hey, look, I want to take a long-term approach, or I want to take this and have 1 to 3 day trades off of it.
Right.
So they can kind of pick and choose. But I think it's important to have that perspective to sit at the helm and say, okay, look, I can look at the entire capital markets, come up with an idea, and then I can structure in the FX market, equity options, equities market, futures. I want to give them the choice to be able to exercise that idea. So,
when we kind of an online trading academy, one of the things we talked about a lot was odds enhancers. And it sounds to me like part of your approach is saying, while I might be focused on the shorter term, the stage is being set by that 30% fundamental perspective. And in understanding that, not only can I anticipate where one asset class may be going, but if I start to put that in conjunction with, let's say, the currency markets and looking at the futures and maybe even now setting up option trades on it, it starts to add up to a greater degree of odds enhancers when I look at this kind of the machine as a whole, right?
Yeah, for sure. So, I mean, and I've already seen it this week. So a lot of students that I've seen struggle with futures trading, I go, look, if you're going to get a large sell-off wave or a large buying wave in the markets, you don't just have to trade S&Ps on that. You can structure it a different way,
right?
Whether it's SPX puts or even the futures put options or call options or SPY calls. So I want them to be able to look at that and structure a portfolio so that when you do get a large sell-off or a large rally, when your portfolio is structured correctly, you're going to make a large return instead of having to take like all these little shots, right, to add up to a larger P&L.
Mm-hmm.
So.
Yeah, and to add to that, I think as well, Dan just hit the nail on the head. One of the things that we've really been trying to say is, Dan's got this great saying that I think we've adopted already about there's many ways to slice the bread, right? And you think about this, Merlin, you've seen it, volatility starts to spike. You take a look at the NASDAQ right now, we're coming into August right now. The NASDAQ is a completely different animal. NASDAQ futures are a different animal to where they were in January or February, right? The volatility's gone through the roof. They behave a completely different way. Man, I used to use a 5-handle stop on that thing. Now I use a 20-handle stop on that thing, when I'm trading intraday. My intraday style has gone from, trying to go onto smaller charts to now I won't even look at it on less than a 1-hour chart. Right, you've had to change, and if that volatility increases, it can be futile just keeping trying to do the same trades on something like that. So what we're trying to do here is say, well, look, that's not your only option. We can do the options on the futures. We could actually just be buying QQQ puts, absorbing some of that volatility, giving ourselves a little bit more room for that trade thesis, that trade idea to work out. And that's exactly part of it. I think with the odds enhancers you talked about, it goes a step further. It's like we've got this portfolio, we've got a whole set of tools, and we've got a market. But sometimes you just need to use different tools for a different job, right? And I think that what we're trying to give people here is, here's how you use the hammer, here's how you use the chisel. Now you've got this piece of marble. We just want to teach you how to use those tools the right way to create your own masterpiece, to create your own sculpture out of it. And we've been coining the term case builders. That's what we call. We're trying to build a case. And Merlin, you've been in this long enough. Anytime you look at a market, you're building a case, right? That's what you're trying to do. You're structuring it. You're saying what's in my favor. So that's one of our case builders. That's one of the approaches we like to take.
Yeah, I like that. I think that, we have to take a step back and look at everyone's kind of arsenal. I'm just curious, in chat, I know we've got a bunch of people here with us today. Let me know how many different asset classes you trade. I guess we can narrow it down to, let's say, 4 or 5 of them. Cryptos, I guess you could count as one. So we'll do equity markets, you have futures, you have Forex, you have options, and I'll do cryptos. And we'll just keep it broad like that. Out of those 5, how many of those asset classes are you guys trading? Just kind of curious to see what the audience is looking at. And I think many of you are probably a little bit more astute and probably going to be trading 2 or 3. But I'm curious to see how many people are just trading 1. And going back to Dan's comment earlier, which was saying, look, you have a lot of people who are just trading one asset class. And if you do that, you could be blinding yourself to an opportunity in something else. And we've all learned this, regardless of how long we've been trading and investing, that there might be a moment where the thing that you're looking at is doing nothing. And you're just sitting there going, for the love of God, move. And it's doing nothing. And you can flip over and look over at something else and go, holy cow, this thing's going crazy. And if you aren't paying attention to those other things, you miss a lot of opportunities. And I think that, part of my challenge when I look at this discussion of fundamentals versus technicals is if you're looking at the fundamental side, you're generally waiting for that monster move. You're waiting for the big play. Technical guys are probably going to be that shorter to intermediate term play. And again, I can't jump on one side and say, hey, technicals rule and fundamentals suck. It depends on what I'm trying to do and accomplish.
I mean, especially when you look at like long-term investing as well. I mean, and finding, good quality investments over poor quality investments. Absolutely. I think the longer the term and the duration of the ideas that you're thinking about and you're trying to construct, the more that those fundamentals come into play. And it's just about using it. But again, like Dan said before, it's about using the right fundamentals. When it comes down to it, earnings right now, PE ratios. I mean, the biggest thing most companies are going to lie about is their internal books. I can't trust any of it. I don't trust anything I hear. But there's some things you do trust. You look at a coronavirus situation, it's real, no matter what some of these crazy idiots out there are saying. It's happening. and the way that the continual printing of money, the fact that interest rates are where they are, the instability of the base of this economy, that's real. And in the long run, that's going to have an effect. And, like I say, we'll have, I think, we talked about last time, Merlin. I mean, I know Dan shares my sentiment. I have a bearish sentiment on the market. And so fundamentally that's there. But right now you've got to ask yourself, does it pay me to be a bear, or does it pay me to be a bull? And that's where the technicals can help it. I always say this, it's okay to have an opinion, and fundamentals give me an opinion, but the technicals will tell me what to do right then. And I can have a long-term negative bearish opinion on the market and think it's going to get real ugly, but it doesn't mean I'm a seller right now. It might be the best thing to me to do is buy this market on a dip. And that's, I think, where you have to know the difference between the two.
Right. Yeah, we can look at fundamentals all day, and the fundamentals may be pointing a bigger pick, maybe pointing one direction, and technicals maybe going another. And that's, to me, that's a big challenge. Although if you understand it, it does represent opportunity. And I'll give you an example. We could have fundamentals that show that GDP and economic growth are just accelerating to the upside and looking really, really strong. And I may have an equity market that's following that as well. But let's say we come rallying into all-time highs and some of these numbers start to falter a little bit. Well, I may be using that to say, even though the numbers look so good fundamentally for our economy, I may be looking for an opportunity to go short here and do a kind of go against the trend, which normally most people wouldn't recommend. But that's me looking at technicals and maybe fundamentals in conjunction with each other, which I think is the strongest way to go. A couple of you not trading. I see a couple of you doing individual markets, doing one thing. The one asset class I would suggest for everybody to understand and get a bigger grip on would be options. I think options is your Swiss Army knife of the financial markets and giving you the most diversity as far as what you can and cannot do. So for those of you that are one instrument guys, I would encourage you to check out the options side of things. Real quick question from Joseph. He says, what are the most important fundamentals to look at when analyzing a corporation? Are you in that school of camp out there, Dan, Sam? You guys looking at individual corporations? Something you look at?
Look, the only thing I ever look at in individual corporations on large stuff is the CDS spreads, right? I just want to see if they're widening or tightening up. It's like an easy indicator to tell whether the stock's heading higher or lower.
Explain CDS spreads for us.
So basically, you have a credit default swap on a lot of these companies, right? So it's just like an option spread. If there's a likelihood that, let's say, like Tesla is not going to be able to repay their debt, right? That spread will start to widen up in that market, which means there's like fear in the market. So if that spread starts to widen on these credit default swaps, it's a bad sign for the overall company. So when you look at a company, typically you want to look at debt first, right? Because the debt in the capital structure, debt holders are above equity holders. Right. So if you look at companies' debt, that'll typically tell you the story of most things. So if you look at a lot of large hedge funds like Third Point, I think Mark Lazzary's fund, a lot of these debt funds. So for example, Third Point, Dan Loeb, I think recently they just bought into Boeing's debt, right? This was like 3 months ago. Now, there's a reason they bought the debt instead of the equity on it, right? So at that given time, Boeing is kind of a national security concern. Like, if they got too low, they're susceptible to a takeover. We can't have like a foreign nation taking it over. So I think in that perspective, they're buying the debt because it's safer if something happens. So if I were to look at one thing, it would just be company's debt load. That's what I would look at.
Interesting. It's funny because I think when most people hear I'm analyzing a company from a fundamental perspective, the first thing they're going to look at is, PE ratios and earnings and EBITDA and all that stuff. And I love it. You're like, I don't care. Are they making money? I don't care, because you know what's going to tell me they're making money? The debt market. And if they're getting debt and servicing the debt, then they can make money.
That's literally it's literally the end all be all. Legitimately, if you look at the credit spreads on a lot of these companies, so if you look back in March, they were blowing out like across the board, and that's just the credit markets always tell you ahead of time what the equity markets are lagging on. So if you can figure that out, the equity market's going to follow. So that's like the direct indicator to equities in companies. So
nice. Sam, are you looking at anything? If I know you're probably not the big fundamental analyst for individual companies, but if you were to, what would you look for, or do you?
I mean, I've always said this, I don't think I'm smart enough to really understand fundamentals. I'm
right there with you.
I'm just an East End guy who just come here and I see things very much from a black and white perspective. But I will be honest with you, all jokes aside, I mean, I've never been a heavy, equities only trader. For me, I've always enjoyed working with like ETF. Like if I'm going to be, I agree with you. Options are so wonderful. That's why we built so much of the Stockability curriculum around options. So, options on those ETFs, those index ETFs, fantastic, and then there's always those go-to equities that options will be good on. But over the years, I've been very active in the stock index futures, I've been very active on, the oil, on the currencies, as which to me have a slightly different, I think it's less to look at, which is why I've always kind of gravitated towards them. But for me, I always look at interest rates. And inflation is a big thing. Interest, looking at those kind of things, and just how an economy is shaped. When I look at this way that debt is also something that you can't escape. And then I look at the escalating debt that I'm seeing in worldwide economies. I look at the borrowing cycle. I look at just how cheap money is. And, one of the things that's always concerned me, and I don't want to get too heavy about this and this because of literally the time's not there, is, but, you look typically economically over any kind of cycle, when you have a really good, strong, healthy economy, you're going to have to start seeing interest rates rise. You're going to rise. You're going to start seeing inflation. And yet we've restructured this whole economy now where here we are just going higher, going higher, but interest rates are going lower. And I think there's a very big, unsustainable problem at that. And it all comes down to that money cycle. Credit is, and John O'Donnell, good buddy of yours, good buddy of mine, always says, credit is the mother's milk of a capitalist society, and it plays a huge part in all of this. But, the thing is, I feel like, from a fundamental point of view, and I'm like, Dan, rather than focus on an individual company, I like to look at the market. And this is why I feel in the long term, this is just so unsustainable because we've built this whole deck of cards. This economy is a deck of cards built on cheap credit. And I think when interest rates do go up, and guys, they will go up, that is the fundamental I'm concerned about. Of what will the knock-on effect be? It will hit stocks. It will hit real estate. It will hit governments. It will hit everything. And the first thing you'll see is in the stock market, because anytime there's any trouble, what's the easiest thing to liquidate? Click of a button, I'm out my stocks. You don't liquidate a house, right? You can't. It takes a process. It takes a time. So it always kind of follows on afterwards. So for me, if there was a key sentiment gauge for me, it's the behavior of the money cycle, the interest rates, the inflation, and just how that kind of integrates into a booming and a falling cycle as well, Merlin.
I like, and that's the fundamentals I look at. We've been discussing kind of the pros and cons and kind of our viewpoints on technicals versus fundamentals, but to me, that's about all I look at with fundamentals. I don't look at companies anymore and say, here's what you're earning specifically or management. I don't really care. That to me is dictating the price chart. But I love what you just said about interest rates. We have mortgages right now. You can get yourself a 30-year fix for about 3%, maybe 3 1/8. Well, that is historically low. And if for some crazy reason we got up and yields started to increase and all of a sudden you are going to be forced to pay, let's say, 6% for your mortgage, there's going to be a crushing effect on the real estate market. And of course, that means that the capital markets will take a big hit. And if we see that 10-year rally from 58 basis points that it's at right now to, let's say, 2%, that's going to completely choke things out. So fundamentally, those are pieces that I'm using as a macro gauge for, we'll call it the micro trading that I'm doing, because I'm generally a shorter term guy. So if I have to rate the percentage of fundamentals versus technicals, I just have to clarify what that technical is. Most people think technicals are earning statements and company financials. I'm looking at mainly macroeconomic stuff, which we talk about on the show, things like GDP, CPI, retail sales numbers, and just to get a sense of what's going on within maybe industries or economies as a whole. I would probably say I'm probably right there with Dan, which is going to be about that 30 fundamental, 70 technical. I would say that the 30 fundamental is formulating my overall opinion about the market, not necessarily an individual company, and then I'm going to go flip over the technicals and refine down and say, here's where I'm entering, here's why. Even if it's against what the fundamentals say, I need to have that in the back of my head, and that's my approach to technicals versus fundamentals.
I think it keeps you honest as well. I mean, anybody here right now, a great buying opportunity for many in March, right? And, with that dip that happened, and, we talked about this last time on the show, I don't quite feel this market's ready to roll over, and I think there will be something that's going to help it. But, from a fundamental perspective, I might have this bleak outlook, but, there's been great opportunity on the upside for buying. But what does that do, that fundamental? It doesn't stop me from buying, having a bleak outlook. What it does, it makes me protective of what I bought and makes me say, hey, I'm going to make sure I've got protection measures in here. I'm happy to buy this thing. I know it's high. Like Dan, you said it on our class just the other night. I hate where this market is. I don't want to buy it, but if it pulls back, I'll buy it. But man, I'm going to protect it because I know fundamentally this thing ain't going to carry on, and I'm going to see, it's not money till you see you're cashed in. You know, profits don't take themselves. You have to take them. So anything you get into on here right now, fundamentally, go with the upside, go with the trend. But man, you got to protect it, because there's a long way down. And I think that's where that's where having that fundamental outlook as well is going to help you put together that trading idea.
Yeah, well, it puts together your risk too, right? So to take that example, so I'm not against being a long here, but if let's just use a arbitrary number. If I want to be a 10 lot S&P long, normal size, I don't see the upside there, but I can't ignore that it might move higher. So instead of running a 10 lot, I might run a 2 or 3 lot, right?
Right.
So my risk will adjust as well based on where we are. So if we get a nice pullback or something, I feel it's deep value, the risk management changes as well. So when you take that perspective from a 30,000 foot view, it allows you to do a lot of things, not only form a thesis, but at least for me, it allows me to formulate risk as well when I put it out in the market. So
I like that a lot. Let me just get your take on this one and see if it equates to what you just mentioned there. You look at something like gold, and I got the chart of gold up here for everybody to view. I'll take that ATR off there. You guys can definitely see it's been curling up and looking really, really strong. You have a market like gold where, technically you can't refute that this is on one unbelievable uptrend, whether it's a fundamentally driven or just a FOMO type of trade. I think if I was to extrapolate what you were saying there, Dan, in a situation like this, let's say you're normally trading 5 contracts of the GC. Well, you know what? While I can't argue the trend, I still want to be long. I have to mitigate my risk. Instead of trading 5, I might drop that down to maybe 2 or 1 because it feels like it's long in the tooth. And normally, when we have something that moves like this, there's going to be a pause, which may allow you to get back into your 5 lot. Would that be kind of a safe assessment?
Yeah, 100%. I mean, gold's a perfect example. I mean, yeah, that's perfect. Like, there's no way I'd go full risk on this thing. It's vertical, right?
Yep.
There's not a shot you could get me to risk the capital to run that. So, in fact, I hate to be the bear on this, but watching this thing, I mean, I've been watching this short gold here soon, because I think we'd all agree it's got to be some kind of let off the gas here soon. And
2,000 is such a beautiful number from a short perspective. Yeah. Like, I'm looking at 2,000, and I kind of feel like it's going to tiptoe above it to maybe like 2,050, and then it's going to have a nice pullback. But, but I'm still in the bullish camp. I think gold long-term is just going to keep on going up. I just think it's a bit overly accelerated right now, kind of like Tesla was a couple weeks back, right? I think Tesla might have great prospects, but the parabolic move just gives you, I'm going to call it the Robinhood effect, right? I'm willing to bet that if we looked at Robinhood right now, the number one purchase stock in the last 24 or 48 hours was what? What do you think? Take a guess. This will put you guys on the spot here. Who do you think's the most...
Are you asking the group or us?
All of you, yeah. Who do you think?
You've been on that website again, Merlin, haven't you?
I'm going to cheat. So I have I have a Robin Track software. So every day it tells me.
Yeah, no, I usually bring that one up. But I haven't looked at it, but I'm going to guess that it's Kodak. So let's talk about fundamentals there. I mean, here you have a company that was the king of film, right? If you wanted to get your 35 millimeter film, you had to use Kodak and go to the processing plants. And they missed that digital revolution like you could not imagine. I mean, they should be a monopoly at this point. They lost it. Now all of a sudden they're getting $700+ million to be a drug company. Who thinks this is a good idea? Robinhood traders do, guys. Robinhood traders think it's phenomenal.
Right. It's the number one holding. I just looked.
Oh my gosh. I got to bring it up just for the viewers to see. That's hilarious. I was kind of saying it as a joke because it's just totally stupid, but it's like, hey, what doesn't make sense? What is an idiotic thing? Let's just give Kodak $750 million to, of $1 billion, right? Was it $750 million, right?
Yeah.
Yeah.
I believe so.
So let me go to I'll bring it up. I got it for the viewers out at home. Here's the page. Yep, Kodak, number one. It went from 31,000 shareholders owning it to 117,000 clients at Robinhood owning it. 85,000 change in the last 25 or 24 hours. That is ridiculous. And it's rather comical, to be honest, because it's like, if you made the list of stocks that you and we would probably look at and say, hey, you know what? I'm not going to buy this crap. It would be Hertz. It would be Carnival Cruise Lines, GNC, and probably Kodak. I mean, come on, this is just ridiculous, isn't it?
Yeah, no, we had a discussion. I mean, I still talk to a lot of my buddies I worked with in Los Angeles in this private group chat, and we were making a joke about, we should start doing in April, and we didn't do it, but put together like a side capital and everything that like Robinhood's buying or not buying, we're just going to go opposite and trade it because it was working. I mean, like Hertz. I mean, How ridiculous was that? We talk about fundamentals. They literally said they're going BK. We're going to issue $800 million or $1 billion in equity or debt.
Yeah.
And it was still getting bought up. So I don't. It just makes no sense. So.
It's kind of comical. Years ago, I actually was making portfolios that would track the inverse of Jim Cramer, because I think about what Jim Cramer did. He was kind of the Robinhood effect. I would go back the last 10, 15 years. He's that guy, antics and buy, and just being a crazy psycho on TV. Very entertainment selling. But a lot of times, those things would rally up huge when he talked about them and then come crashing back down. Keep an eye on Kodak. I haven't even looked at it today. Maybe I'll bring that chart up here for you guys. Just take a peek at the chart of Kodak, because it's comical what it's been doing. KODK. Here's your Kodak chart. Oh, this is. Oh,
right. I was 31.50 right now, and aftermarket out.
I was laughing at it yesterday at $10. It hit the $60
on the way
today.
Back down to 10, people.
Wow. Oh my goodness, that is hello Robinhood. Now, let's see. One of the things
one of the most important things, you'll like this one, Dan. I don't think we ever shared it, but I'm sure we did, Merlin. But one of my first mentors, he always said to me, and I made a little bit of money in a bull market. I remember when I was getting into this, 17 years ago, and coming off the back of the big crash in 2000, and then just the first stuff I was buying in the early 2000s. We had that first bull coming off the back of that, and I was like, hey, I bought some stuff today. I made money. He's like, good. And the next week, yeah, I bought stuff. I made money. Good. And this went on for a few weeks. And I'm like, I feel I've cracked it. And he looked at me and went, kid, don't mix brains with a bull market.
Yeah, exactly.
I never forget him saying that to me.
And I think, we have all been around the block a while and traded for a long time. And one of the funniest things right now is that phrase, Sam, could not be more evident than it is today. I'm watching guys on Instagram. So I have all these different social media platforms. I've been trading for well over 20 years. I mean, it's what I do every single day. I've got a ton of experience. And I look on Instagram, and I've got 200 followers on Instagram. I could care less. But there's some kid out there, he's got 500,000 followers on Instagram talking crap about trading Forex, and I can tell you right away, within 1 or 2 comments, he hasn't the slightest idea what he's doing. And this guy's making money actually it wasn't Forex, it was a Robinhood account, excuse me. He has no clue what he's doing. It's just, I'm making money in a bull market. So I'm really waiting for the crash to wash all these morons off the table so I don't have to listen to their, all of a sudden, instant geniuses in the marketplace. I mean, these guys are all brilliant. They tripled their accounts in a week. Great, bravo. You're going to lose it all. I promise you when these markets crash.
The easy bit when you don't know what you're doing is making money. That's the funny thing. When you don't know what you're doing, making money is the easy bit, And it's funny, when you talk about that, Merlin. I mean, Dan and I have chatted about this, and you can go on YouTube and you can find people who've got 500,000 subscribers to their trading channel on YouTube. But the irony is, what no one seems to recognize is that person with 500,000 subscribers, they're actually getting paid from advertising by having 500,000 subscribers on YouTube, and they're just talking garbage. And guess what happened in a few months from now, you won't ever hear from them again, and it is tough. And it when you do know what the safe way is to play the market, what the safe approach is. You get the amateur money comes in, and if the amateur money never had any success, the amateur money would never come to the table, and you're going to see these parabolic moves where everybody and their aunt and their uncle and their dog and their cat are buying, and they make money, and you're sitting there going, you know what, I got to sit out this because it's not the smart thing to do, and it goes without. But then that's where the patience comes in, because then you have to say, look, I know how this is going to go, so. It's almost like you miss out on a short-term opportunity because of doing the right thing, and they make a gain from doing the wrong thing. But then in the long run, you ask yourself in the years to come, who's going to still have an account left? Mm-hmm. Who's still going to be able to know what they're doing? And that's it. You get sometimes a little bit punished for doing the right thing, but in the long run, I'd rather take a little slap than get beheaded. And that's just balance, right? And you've seen it, Dan, yourself with these guys on the internet, right?
Yeah, I've always said it too. It's like, look, if I get into a trade, whether it's a long-term or short-term trade, I don't mind. If I did everything right, I don't mind. I mean, I hate losing money, but I don't beat myself up about it. It's when I get into a position and I know I shouldn't get into it and get in it anyway, that's when I get myself into trouble. So as long as the process is the same, I don't mind taking a stop out or the loss. But I've seen this. You saw it March and April. I'm not gonna I think it's ridiculous. I saw some crazy P&Ls, ridiculous stuff coming through, and I was like, and when it started to sell off, I was like, thankfully, this is we needed this wash up.
Yeah.
And it's bad to say it, but honestly, it's how I felt. You should see ridiculous P&Ls. I'm like, you're not gonna sustain this.
Yeah.
I literally had a friend of a friend. Said we met Ophir. We were in Austin. One of his friends. We were hanging out. after the market having lunch, and he goes, he just bought Hertz after the market. I go, no, he didn't. I go, this was at 70 cents. I go, I bet you tomorrow morning that stock's going to double. And he's going to make 20 grand on this thing, and he's going to laugh at us.
Yep.
Sure thing. Next morning, the stock's at $1.50, $1.60, and I go, you know what? If I go in and buy this, 10 grand worth, it's going to zero. But he buys it, and it like doubled up, and I was like, all right.
You know, it's funny. My mentor years ago used to say that the stock market's like a drug dealer, and you know the seasoned veterans, they know how to deal with their drug dealer. They put him in place, but the amateurs, the drug dealer's always giving you a freebie, and here just to get you hooked. And I'll tell you, when you buy Hertz at 60, 70 cents, and it's $1.60 the next day, you're hooked. I mean, that's an addiction waiting to happen. For the gentleman who was saying you bought puts on Kodak, be careful out there. The implied volatility for Kodak has just skyrocketed. Yeah. So you may be totally right that Kodak's going to go down, but you may have paid so much in premium for your option that even though it goes down, you may still not make money. That's one of the things you got to know about options. Timing is everything, and I'll bring up the implied volatility chart here just so you guys can take a peek at that.
It's got to be like 150%, 200%, right?
It's at 285 right now.
Oh yeah, there you go. That's ridiculous. So on a situation like a Kodak, or even Tesla as of recent, you want to be a seller.
So
like you would have been better off selling call spreads on that thing, or even honestly puts on it.
Yeah.
Because the puts will probably make money selling the puts on it.
Yeah, you know, and that's a challenge. You know, we talk about understanding the different asset classes, and I emphasize options. You look at something that's gone from a couple of bucks to $60, and your brain, all of our brains right here collectively, including everybody in chat's going, hell yeah, I'm shorting this thing. It's going down. But remember, the pricing mechanism for options is different. You're paying a premium. Quite often it's tied to implied volatility, and this one's doubled in the last 24 hours. So
those puts on Kodak right now, what you've basically done is you've just paid about a $50,000 premium for a $500 car. You know?
No.
It's, you know what I mean? It's like, you know, you've literally just insured a scrap heap, you know, and that's what's happened. You're never going to get that money back on that.
Those 30 strikes have a 340% implied vol.
Yeah,
340%. I mean, gee.
Yeah, and if you he says you bought him deep out of the money, which is fine, but still you're still paying way too much. And even at 30s, yeah, I don't know. You know, my guess is this thing's going to drop back down even further than that. But this is just a crazy spike that's going to wipe people out.
Make sure you can also get out of them as well, right? That there's enough interest to open interest when you're ready to get out. That's the other tough thing as well. You know, it's one of the ways we look at the options market is it's just a watch list of the same things over and over again. You know, the open interest is there and the liquidity is there to be able to make it worthwhile when you are on the right side of it too. Yeah,
to give you the open volume for a 1 week average was 44,800, and today you're at 133. So you're far exceeding the amount of options that are even out there. There's just people just buying everything they can. So this is a dangerous situation, and you know, while it may just reek of opportunity to you, I will tell you this from my perspective. It's this. I use this analogy a lot. One of my favorite things when I was traveling through Europe is going to a lot of the different street markets. And there's one in Barcelona called Las Ramblas. It's a very famous street with a lot of street performers. And, you know, let's say I'm walking on the street and I see this guy and he's juggling, you know, tennis balls. He's got 8 tennis balls going in the air and it's amazing. And I'm like, yeah, here's €1, right? And then I go down a little bit further and there's a guy, he's juggling chainsaws that are running and there's smoke spewing out of him. He's got 3 of these things and it's incredible. You can't not watch because you know it's a tragedy waiting to happen. Come by another year later and the guy's, you know, I'll stand up. He's no longer juggling chainsaws. He's got 1 chainsaw and he's got 1 arm missing. Like, hey, what happened? It's like, oh, well, one of them got me. That's what happens in crap like this. Stay away from Kodak, guys. Leave that thing alone. This is just it's like a high-end pump and dump right now. It's bizarre. I would just totally leave it alone. All right. Do you ever take any high flyers like that, Dan, Sam? I mean, this to me is one that I wouldn't even entertain. I just walk away from. But do you ever engage in those? Is there an opportunity that you see?
So look, I was so busy. If I had seen this today, I probably would have started selling call spreads all over this thing to take it's basically free money. Call spreads, I got to be at this point. But yeah, sometimes I'll take like really small positions and. You know, I consider like a long synthetic call option that doesn't expire. So let's say like Tilray, for example, when Tilray came out, I bought that like 2 or 3 grand worth. And if it expires, it does not going to expire, right? But if it goes to zero, it goes to zero. But if it takes off, I just make all this money. So I do sometimes, but it's never with any I would consider real money. It's just very small amounts. So.
My hope is
it's a bit like going down the racetrack, right? I mean, I look at opportunities like that as you're having a night out, or you're down at the on the roulette table, and you're going to just bet on a number. And at night, your 35-1 odds come in, and it's like, woohoo! Tonight I got lucky, and you were blind drunk in the first place and didn't even realize you put the bet down. But don't expect to go down to the casino every weekend and make a career out of it. It's
not it's not sustainable. I mean, the method I use is pretty much the same, like set of equity and ETFs over and over. I trade West Texas a lot, and S&Ps and NASDAQ. So it's just wash, rinse, repeat at this point in my career. So
it's so funny. They say at its finest, trading is a very boring profession. My curiosity is, remember, like it was a year ago, you had these idiots. It's not even millennials. I don't know what generation it was, but they probably won't last long. They were eating Tide Pods, right? This Tide Pod challenge. Given this whole thing with Kodak and how Kodak is now going to be the one that comes up with the COVID relief, I'm sure that somebody is convincing some generation to go out there, and if you take old 35 millimeter film and chop it up and eat it, that you'll get rid of COVID. It's coming out soon. Watch. It's crazy.
Yeah.
Absolutely. All right. Wouldn't surprise me.
No. All right. So you guys just launched. I know it's been a soft launch. I think now you got some classes going on. Anything you guys want to tell us about that before we wrap up here today?
So today's actually kind of like the first day of our pre-launch. So I've been on the show, a while now, Merlin, and coming and, been what's going on. So I talked about it last week, but officially, the name of our company is Stockability.com. Well, we are Stockability, but that's our website, Stockability.com. A work in progress for almost 3 years now. So Dan and I are super excited. I think I told you we did a closed launch a couple of weeks ago. We're already got like a ton of students in the room. We're working with them. Dan's actually teaching the foundational abilities class this week. We're on night 3 tonight, aren't we, Dan? Doing that. Next week is our options abilities class. And we're taking a week off. Then we've got our income class, which I'm going to be hosting. And then our wealth class coming up next week. And we've been doing our trading sessions, in our live guided trade sessions as well. So really kind of introducing, the students to this methodology. And, he won't say it, but I will say it. It's been so exciting for me because you've just heard in this interview, and I wanted to, I knew Dan, you just gel with Dan Merlin and with the conversations we've had. Dan's perspective is so fresh. We hear all these people talk about the institutional side of things and working with hedge funds, working on floors, but Dan's got such recent experience. And, what happened 30 or 40 years ago isn't the same game as what it is today. Right. And it's been so cool to be able to team up with Dan, and I feel very honored about it, to take this and all the things that I know and be able to put extra layers onto it and simplify it at the same time, and then bring Dan to this. And, I'm like, guys, don't worry about it. You've heard me before, to all our students. Now it's time to listen to Dan and just offering his perspective that, you can just hear it. You just hear the things he'll talk about. The students are like, wow, I've been doing this for 10 years and I never even considered that. I mean, Merlin, it's been an eye-opener this week and it's been a wonderful thing. So, this class we've got going on, and it's a shame it's a quiet market right now, but it's the summer doldrums. Yep. So we've been really, really getting into it, and I wanted to just let Dan share a bit about how he's been finding it, getting back in the seat as well. And we've got this very cool referral programs going on, which I'll tell you a bit about as well. But I mean, Dan, you've had a blast these last couple of days. You're tired, I know, but
look. So it's been a year and a half since I really probably a year and a half. Yeah, almost 2 years since I last taught a class. So it's interesting for me. I had to get back into the rhythm of it. And remember how to teach a class. Not that it's like riding a bike.
But it is. There is an art to it, man. There really is an art to teaching.
Yeah. Look, it really is. Not to go too far back, but when I first started, I had no idea how to teach. I had to literally tell a group of guys who were like, "Hey, they were futures traders." I go, "How do I teach you guys?" I have no idea. And they go, "Well, let us watch you trade first, and then we'll ask you questions and explain it." So I've learned over the years how to teach and how to get an efficient message out, but do it in a way where people can actually understand it in a short amount of time. So the first week has been really good. We've got a lot of good feedback so far.
Good.
I'm really excited for the options abilities class next week. I think I know for sure from OTA, it's like a 180 of what you guys have done there. So cool. I think it'll be an eye opener, and people hopefully they enjoy it. That's my hope. So
cool. Well, good. I mean, so far so good for you guys, and I appreciate you coming on the program talking about it, giving us some market insights, fundamentals versus technicals. I think we would agree that technicals win, but not like a landslide victory, guys. I think 70-30 is kind of the common thread that we've come up here with regards to fundamentals versus technicals. So if you guys want to know more, go to stockability.com. I think we've actually had some emails up there. I think I had yours up last time, Sam. But if you guys want to know more, go to stockability.com.
And I was going to say as well, Merlin, we're doing something pretty cool right now. So you can go to stockability.com, and if you register your name, your email address, and your details, we're actually doing a very cool referral program right now. So as people spread the words to the rest of their contact, they can actually earn free education. They can actually earn, our foundational class and our wealth class and different programs on there. So come and actually earn some free education. And these are not taster classes, and these are actually the full-on class. So if you go on the website, stockability.com, it'll tell you how to do that as well. And we were doing a little bit of give back straight off the bat as well. So we're excited about that too.
Awesome. Well, gentlemen, thank you so much. Thanks for making this our first threesome. Sounds totally awkward, but it's the first time I've actually had three people on the
Merlin, but I get the drift.
I've never actually had three people on the show, or two people on the show. It's been pretty cool. So thank you guys so much. Look forward to having you back on again soon, my friends. Take care.
Thank you, buddy.
Thanks.
Cheers.
All right, guys, that was Dan Bustamante and Sam Evans of Stockability.com. Technicals versus fundamentals. It's one of those ones that, sitting around the cooler or at the bar or wherever, you could go on and on and on and on debating the validity of one or the other. And I think what's important here is if you guys ever do get in that debate, don't get so lopsided that you get angry at the other person for what they believe in. I'll say that because I know a couple of guys who are 100% fundamentals. They won't even look at a price chart. It's just, what is the balance sheet saying, and they buy. And they're doing okay. So, I can't look down upon anybody who says it's all fundamentals or all technicals. I think we find out what our natural mix is. And I actually like Dan's perspective. I think for me, it's about 70% fundamental or 70% technicals, 30% fundamentals is probably right about where I'd be. I maybe go a little bit less than the fundamentals, maybe 20-80. But all in all, it is important to us as our trading and investing careers progress to look at what that big picture is doing. So macro fundamentals, and then whittling it down to the shorter term and saying what are the company specific fundamentals. Something that Larry Jacobson talks about in the program quite a bit. We may actually try to get him back on here soon. I'm trying to get him back on just so we can talk more about that in the near future. All right, what do I got today? Did I not update this? I didn't update the economic calendar for some strange reason. Awesome, Richard. Glad you found this session very informative. We try to make them all rather informative. I don't have the economic calendar up for tomorrow. I will tell you what some of that stuff is right now. I actually had it all set, ready to go, but for some reason I just didn't get that set for us. Here's what's cooking for tomorrow, guys, and this is, again, the most important stuff that you probably heard about, some of the jabs back and forth. I guess Google just doing rather well with regards to their testimony today in front of Congress. You'll notice that tomorrow, after market close, is the super crazy, amazing, unbelievable popcorn trade of the week. Popcorn trades of the week. Yes, because you have Apple, you have Amazon, you have Facebook, and you have Google all reporting earnings after market close tomorrow. It is going to be crazy. My thought would be we were just going to talk about that for most of the show tomorrow, but we're not. We're going to talk actually about trade planning. We're going to have Corey Lane on the program. We'll look at different asset classes again, but really talking about trade planning is be our focus for tomorrow. So that's what you got cooking with regards to your earnings calendar. Some of the other names you may recognize on here, you've got Ford, which is the most widely held Robinhood holding, by the way. MasterCard, Gilead Pharmaceuticals, Procter & Gamble also coming up to some key levels on PG. You have UPS, Northrop Grumman, gotta love the defense stocks, Valero, Eli Lilly, both shares of Google as well as Southern Company, and many, many more. I believe there's 315 companies reporting earnings tomorrow, so it might be in your best interest to be careful and not really carry anything home overnight. I really feel that this testimony could potentially cause some damage to those FANG stocks, or at least the GAAP stocks. If that happens, then all of a sudden we'll see this market have a little bit of a rip down. Then see what happens after earnings. What's interesting is this is the last really of the big FANG stocks. I think after this happens, what's left? What do we have? Remember, the FANG stocks are the ones that really have been pulling this market to the upside. And if all of a sudden those companies are not reporting earnings and the other companies are, which have been dragging the company or markets down, that could really be problematic for our equity markets going forward. So it'd be very interesting tail end of the week. That's what we've got cooking for tomorrow. Again, if you guys have any questions, you can always feel free to send those comments and questions in at TraderMerlin.com. Just go there and type in your message. You can actually send in documents and pictures as well if you want to send me stuff to look at. If you want to put comments down below the video, I would encourage you to do that. You go down to our YouTube channel and put it down below there. I usually answer those on the air with priority. And of course, you can give us a thumbs up if you liked our guest with Dan Bustamante and Sam Evans, and also subscribe to our channel. Jeff says, because Ford is a $5 stock. Yes, of course. We know that the Robinhood traders and people with a little bit of money like the cheap stocks, which doesn't really make much sense because 5% gains on a $5 stock is the same thing as a 5% gain on a $1,000 stock. Go figure. Oh, well. Let the math work there. All right, that will do it for today, everybody. Thank you so much for joining the three of us on today's program. Hope you got some good information out of it. Again, hit that thumbs up button. Share it if you want to. We will see you tomorrow with Corey Lane of Traders Army. Take care. I'll see you tomorrow.